The benchmark Nifty finally tops the 25,000 mark. Utilities, energy, metals are the key gainers, even as realty and auto drag. It's the mid-caps which underperformed today.
Infosys receives a show cause notice for a hefty 32,400 crore rupees, which it counters, saying it is fully compliant with regulation and eligible for refund against exports. The company is in the process of responding to the notice. The street shrugs off the claim.
Maruti pips street estimates and points to a pickup in rural demand, as well as a shift to SUVs from small cars. Also sees exports picking up and draws plans to launch 10 new models by 2030. Analysts give the stock a thumbs up.
M&M CEO Anish Shah argues there should be a conglomerate premium vis-a-vis a holding company discount for an entity like the Mahindra & Mahindra Group. He adds that there's more scale left in the combined tractors and SUV businesses with synergies in technology and talent.
India's Q1 tax collections are up 26%, while income tax is up 50% year-on-year. However, the government capex is down 35%, while core sector for June also flags to 4% versus 6.4% in May. You're watching us here on Halftime Report, and at halftime we have the Nifty at 25,000, holds on to 25,000. I'm Mangla Malu, with me Surbhi Upadhyay, and as we speak about Nifty at 25,000, let's give you some good news as well. The numbers are out, and it's the budget numbers that we're talking about. It is final that India watched Budget 2024 with CNBC-TV18 on CNBC-TV18. In fact, CNBC-TV18's dominance continues, and it knocks out the competition on Budget Day. CNBC-TV18, the clear number one, with 91.2% viewership during the budget speech.
Yes, in fact, continuing its 25 years of leadership, CNBC-TV18 wins another gold on Budget Day. Thank you, viewers, for your consistent patronage, trust, and your continued support. So some good news to share as we kick off the show. And some good news when it comes to Maruti, because Maruti's numbers have been very well received by the market. The company has posted a strong performance in the first quarter, beating street estimates. Maruti points to a pickup in rural demand as well as a shift to SUVs from smaller cars. Our colleague Vivek caught up with Rahul Bharti, Executive Director, Maruti Suzuki, to discuss the company's first quarter performance and began off by asking him about the moderation in the demand environment. Listen in.
The demand has been slightly muted this year right from the beginning, and that was fairly known, and we had announced it also. The industry body, SIAM, had given out a forecast of a low single-digit growth for the year. But that's perfectly all right. I mean, it's not a cause for worry because India is at a high level of about 4.2 million cars, the domestic market size last year. And with such high levels, once a while, the market does take a breather. And India has a long-term potential, so a few quarters here and there don't matter much.
Okay, so going forward, even though there could be a little bit of demand moderation, you continue to remain quite positive. Now, next up, give us a sense of the breakup. Number one, in terms of the various segments that you're present in, how is it that the SUV segment is doing? We understand it's potentially giving a much higher contribution to the revenue mix. And number two, yesterday in the conference call, you've also indicated that the rural segment demand has been higher than urban. So give us a sense of the demand trend.
Okay. So, see, it is true that for a long time, for us, the rural has been performing better than urban. And I hear recently that two-wheelers and FMCG sector has recently picked up for rural. But for us, rural has been doing good for quite some time. In terms of the domestic market segmentation, the SUVs have gone up from about 50% to 52% of the market. Vans are at about 8 to 10%, sedans at about 7 to 8%. Hatches are also slightly degrowing. They have gone down by about 2%. So that trend towards SUVs is continuing.
What clearly stood out in Q1 has been the very strong expansion as far as EBITDA margins are concerned. So both the ASP as well as margins were a positive surprise. Now going forward, car makers like yourself have started giving discounts. So will we expect some demand moderation? After that, also some margin contraction that could come in on the back of these discounts that car makers like yourself are giving?
See, in this Q1, at least as far as margins is concerned, there was no one-off. There was an expansion sequentially from Q4 to Q1 by about 30 basis points, which was, of course, the resultant of several factors, raw material, of operating income, of manufacturing and admin efficiencies, etc., and some negatives also, like operating deleverage because of volume shortfall in advertising costs, etc. So there was a sequential 30 basis points expansion. As of now, we don't see any major challenge going forward. Of course, the uncertainty is always there going forward into Q2 and Q3. And on discounts, it will depend on the market conditions so far. Q1 itself, the discounts were up with respect to last year and last quarter, the previous quarter, which is Q4, the discounts were slightly higher because last quarter there were some supply bottlenecks which have now been removed. So on discounts, we'll see as the market goes.
Understood, sir. Give us a sense of the competitive environment too. What kind of market share do you think you can sustain at the end of FY25? And going forward, next couple of years, what is the kind of market share trajectory you envisage?
See, we used to be at 50%. So our long-term goal, let's say by the end of the decade, is to get back to that figure. And if we have the right set of products, the right set of technologies with all the benefits that we have in our service network, it should be we should be getting back there. Of course, it's difficult to predict in the short term, but at least we would like to improve from here on.
So you've guided the street that from calendar year 2025, we will see one new electric vehicle launch till 2031, and also
On an average.
Yes, and also a couple of new ICE launches as well. So given the strong launch pipeline, what kind of growth targets are you setting for yourself, at least in the near term, in terms of revenues?
So we have mentioned that by 2030, we'll have about 28 models in all, 2030-31, and about 6 of them will be EVs. And if from now, let's say from next 25 to 31, we have 6 EV launches, so that's practically on an average 1 EV launch every year, practically. So, and other than these EV launches, there will be other technologies also in hybrids, in ethanol, in flex fuel vehicles, in CNG, CBG, etc. All clean technologies we would like to be present in and increase our presence.
So one last question from our end. Do leave us with a comment as far as the tax policy on hybrid vehicles are concerned. What is the latest that you're hearing from policymakers on this? And if you could also quantify the kind of benefits that someone like you could see in case we do see an extension of these kind of developments.
Policymakers look at national objectives. They do not look at specific companies or individual business interests. There are 2 national objectives that are important at the moment. One is oil import reduction, and the second is CO2 reduction. Now, as far as hybrids are concerned, they generate about a 35 to 45% improvement in fuel efficiency. And they generate about a 25 to 30% reduction in CO2 over pure petrol or diesel engines. So that's a huge jump. And the benefit of this is The strong hybrid technology does it without the need of external charging infrastructure, so customer adoption can be really fast. Many policymakers are realizing it across central government and state governments, and we hope whenever they translate it into actual policies, that will have a very positive impact on this particular technology that was slightly at a backseat till now as far as policy was concerned.
All right, that was Maruti speaking about discounts in the first quarter, but no real challenges to the margins. Going forward, it will be important to track the new launches and what the SUV trend does as well. More importantly, from a stock market standpoint, we'll also look at the Hyundai IPO, which happens in the second half of this year, whether there would be any capital allocated towards that as well or not. The stock opened very well after an up move in yesterday's trading session. Now off the highs, still holding up in the green as we await monthly numbers coming in too. Take a short break, come back, we focus on the primary markets. The management of Segal India joins in as the IPO opens today. Stay tuned. Welcome back. Let's get chatting about the primary market. Segal's IPO opens up for bidding today. Segal is a Ludhiana-based EPC contractor. The infra player is offering shares in the range of 380 to 401 rupees a piece. Fresh issue is closer to around 650 crores. Majority of that used to repay debt and some to buy equipment as well. The MD, Ramneek Sehgal, and Group CFO, Bhagat Singh, joining us shortly. But we have Mr. Sehgal with us. Mr. Sehgal, just a couple of questions first up. If you could tell us, as of date, what exactly is the order book that you're sitting on? What is your execution pipeline over the next 12 to 18 months? And with the money that you will use to repay debt, what remains the debt on your books?
Hi, first of all, thank you so much for having me over. And our order book value is close to 9,400 crores. And if you talk about company is present in more than 10 states. We have a lot of verticals. If you talk about Segal, what Segal does everything what comes on the road. So starting from highway, expressways, elevated roads, then railway overbridges, railway lines, runway, metros. Above all, we do tunneling business also. So talking about the proceeds, 684 crores will be utilized to reduce the debt. About 99 crores would be used for machinery, and rest is general purpose.
Mr. Sehgal, since you mentioned the proceeds of the issue, let's go there first. After you pay off these borrowings, how much debt will still remain on the books? What is your current debt equity ratio, and where do you target it to be, and where do you want to bring it down to?
So, the debt would be negligible. At the company level, it's around 600, and 414 crores will be reduced. So, it will be negligible. And other is a non-fund base, which we require it for all our bank guarantees, which we have to give it for performance bank guarantees or surety bonds at the time of the bidding.
Right. Your order book, you said, was close to 9,400 crores. If I look at the way your revenue has been, it's increased from closer to 900 crores in March 2021 to close to 3,000 crores now. What is your execution pipeline now? This 9,000 crores, over how many years does this get executed?
So the timeline for the execution of this order book is close to 2.5 to 3 years. So little background I'll give you. So last year we have done about 33% ROE and about 50% CAGR. And as a company, a 60% order book value is from structure work. So we have just completed more than 95% Delhi Saharanpur, which comprise of 11.24 kilometer of the elevated structure. It is one of the longest 6-lane elevated structure. Companies engaged in executing one of the longest 4-lane elevated, which is in Bihar, which is about 19 kilometers. The project is worth 1969 crores. And the project which we have already completed more than 95% is 1,500 crores. We are doing a bridge over a Kosi bridge, which is close to 781 crores, which is funded by ADB. And we're doing 2 metros, which is Kanpur and Agra, close to 815 crores. And we have quoted for one of the longest metro of the country, which is in Agra again for 1528 crores. And the competitors in that bid is L&T, Afcons, NCC. So you can understand we are not in any rat race. We don't want to do what a typical road contractor does. So we are going in a specialized league, specialized structure business where we want to do specialized structures, longest elevated metros, freight corridors, railway lines, tunneling, or any specialized job available in the country. Thank you. And I will add one more thing. Last year, turnover, our single tender eligibility has gone to 57 crores and EPC in NHI, and HAM projects is about 5,500 crores.
Coming to that, we need some more granular details. Shareholders want to understand, I mean, your future shareholders want to understand the model and the strategy. Now, your order book currently is 9,500 crores. Just small answer so we can get in more questions. You mentioned a couple of the recent bids as well, because I believe after elections, now the activity is starting to pick up again on the bidding side. What is your L1 book currently? How many orders are you L1 in?
9,400 crore is the present order book value available with the company. Our 80% of the order book value is from NHI. Rest is divided with the Metro, Bihar State and Road Bridges Development, which is under ADB. And we are doing one runway also. So we have quoted for another 16,000 crore project, which is throughout the country, which has this Metro project also. And
so
elections are just got over and bidding fees have been started. So we have availability of about 800 crores as spare BG and bid security, so we can bid up to about $10 billion.
Okay, so let me bring in Mr. Bhagat Singh as well. Mr. Singh, same question to you. We're looking for two numbers. I believe 9,500 crores is the contracts you've already won. That's in the bag already. What is the total value of orders which are in the pipeline where you might be L1? That's the number we're looking for.
So you know what? Answer this story. So it's very difficult to predict anything. We quote as per our EBITDA levels, the two-digit EBITDA levels. So I mean, we can bid more. For us, we can bid in more verticals, we can bid in more states.
Right,
but
we get that point.
At EBITDA level, that's more important. And order book
we take that point. We take that point completely. We take that point. Your business has grown. You can bid higher. You have orders worth 9,500 crore in the bag already. You want to bid for specialized projects, move away from the road projects, etc., regulation projects. Here's a question from future equity shareholders of the company. Over the last few years, your revenues have grown, your margins have improved as well, but all of that has not translated into cash. I'm looking at your cash from operating activity. March 2021, you had CFO of 103 crores. Then March 2022, it was a negative 135 crores. March 2023 was a negative 73 crores. And March 2024 was a negative 211 crores. So all your orders, all your revenues, all your EBITDA margin, unfortunately not reflecting in the cash flow from operations. What is the plan for that?
Great. Bhagat will answer this question since he's the CFO.
Good morning. Good morning, everyone. Thanks for arranging this interview. So before I reply to your query, what is important is we need to understand the business model of the company. The first business model is EPC, wherein whatever we bill to the authority, that is NHI, we get the collection on a monthly basis. So there is no receivable in the books. But as far as the cash flow from operations is concerned, which you are discussing, so these cash flow from operations are negative on the console level. So console level means it includes the cash flow from the parent company as well as the cash flow from the SPV company. The SPV means HAM project. In the HAM project, whenever we execute a project, 40% of the amount is received during the execution period and remaining 60% of the amount is received over a period of 15 years in the form of annuity. So slowly and slowly, when we progress, when we execute the HAM project, the receivable in the HAM project increases, and when you calculate the cash flow from operation of the SPV, it turns out to be negative. That negative is in the form of accounting treatment. It doesn't mean that the cash flow of the company is negative. I elaborate it further. Standalone cash flow from operation of the Seagull India Limited, they are positive from the last few years, post working capital changes. The HAM project which we are executing, on account of the model of the project, if we execute a 1,000 crore of a project, we are going to receive the 40% of the amount of the work done during the 2 years. Remaining, the authority pay us in the form of annuity in the next 15 years, along with the prescribed rate of interest. So slowly and slowly, as and when the work completed, the HAM receivable increases, and ultimately the cash flow from operations also turns out to be negative. But this is just an accounting treatment. It doesn't mean that the executed work cash flow is negative. The work executed cash flows are positive. And just to give you a further and a brief, a further strength line, apart from the cash flow from operations, which are positive in CCL from the last few years, the CCL cash flow got a further support from the SPV because the HAM project, which we have already executed and completed, we are getting an annuity, annualized annuity of 80 crores for the first HAM projects. And in future, as and when the HAM projects will be completed, it will further strengthen the cash flow of the entire group in the form of annuities. Thank you.
Which is Mr. Singh, which is exactly what I was coming to, because over the years we've seen that most infrastructure players, they are preferring to go via the HAM route because you have that 40% inflow coming in straight up front, right? Now your mix between EPC and HAM from what we see right now is still more skewed towards EPC. 61% of your book is EPC, it's lesser HAM. So just tell us, I mean, in the future, are you planning to bid for more HAM projects? And if yes, how does this mix change? And more importantly, we are bothered with margins. Now, at the EBITDA margin level, your margin profile has improved to about 17%. What is the run rate that you're targeting, sustainable run rate, say, over the next 1 to 2 years?
Two things I would like to elaborate. Number one is, for us, what is important is we are not into any order race. We bid for a contract on the basis of the targeted EBITDA margins, which is prescribed by the management, both for EPC, which is a double digit, and also for the HAM project. So our motto is whenever we bid for a project, this prescribed targeted EBITDA margin has to be taken into consideration while bidding. This is the first part. Number two, ma'am, we are more keen to work on pan-India basis wherever the profitable contracts are available for execution. Since the CCL pre-bidding qualification is 3,700 crores for the EPC and 5,500 crores for a HAM project, which is one of the most highest bidding qualifications. We believe that the competition would be quite less and CCL will not face any issues while tendering. Further, number 2 point, ma'am, as you asked me, what will be the trend of the future margin? So since my company is into IPO, we can't talk about the future profitability, but yes, we believe that the company, since we are following a uniform philosophy since inception, so we believe that the work executed in future we may be able to turn out the profitability which we have already achieved in the past.
Wonderful. Mr. Sehgal, Mr. Singh, thank you so much for joining in, explaining your business to us, talking about what your plans are going forward as well. But, we wish you good luck. Once you list, we'll invite both of you all to join in, and that time we'll press you for a lot more numbers around, your earnings, etc. as well. Wish you good luck. With that, we take a short break, and as we do that, we're thrilled to announce that the College Connect program under our ongoing season of HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective recognizing college students as the leaders, opinion makers and change makers of tomorrow. This unique initiative encourages the youth to foster inclusive and diverse workplaces, drive gender parity and tackle societal and business challenges as well when they join the workforce. We're catching them young in the colleges itself. We're kicking this off with IIT Delhi on August 3rd from 3 p.m. onwards with some of the biggest leaders and voices joining us. Stay tuned. You're watching us on Halftime Report here, halfway through the trading session. Perfect time to get you a peek into what the market looks like right now, especially from an F&O standpoint. The Nifty hit the 25,000 mark earlier and now has fallen below that 25,000 mark. And that's largely because of the Nifty, seeing some bit of profit taking. The Nifty Bank also falling off highs. In the Midcap index, that's been a bit of a problem pocket, down about 0.75%. And that's, exacerbated if you look at the way the advance decline ratio has been. We had more stocks advancing at the start of the day, then at some point we had an intersection, and now the decliners are a lot more than the number of stocks which are advancing, and that makes us look at how the market would be in the second half of trade, especially because it's weekly options expiry on the Nifty as well. And the jostle for 25,000 continues. 25,000 put writers are pretty active now. They're covering some of their positions at a premium of 30 rupees, so we may see some further sell-off. And at the same time, the 25,000 call writers, they've come back, and we've seen some action at the 25,000 call as well for a premium of 25 rupees, telling you that those who are writing both 25,000 call and put are looking at a range between 24,950 to 25,050 itself. Were the range to break in or break out, we would see further moves on either sides as well. The stocks that are on my radar today, India Mart and Birlasoft, both of them have seen huge open interests beyond the market-wide position limit. So these are the stocks which may go into F&O ban today. We'll keep an eye out on them.
All right, Mangalam, thanks for that quick run through. Let's now go across to Aditya Agarwal. Aditya, what are your trades for today? Stock ideas?
Hi, good afternoon. Thanks for the show. Markets are a little wobbly, as Mangalam also pointed out. So I'll go with a long and a short trade because clearly there's a tug of war between the bulls and the bears at the moment. 24,950 is a make or break level for me. If that is held, maybe in the second of the trading session, we can see a short covering rally. And within all this, I think Bank Nifty could be the joker in the pack. If Bank Nifty starts to hold on ground and starts to outperform from here on, we can actually see some kind of a short covering rally towards the end of the trading session. So considering that, I've got two trading ideas. One is from the banking space. It's a long trade in the Axis Bank. Because stock has seen a decent correction of late, and I believe offers a good risk to reward at current levels, has come to support levels. At current levels, one can initiate a fresh long position for a target of 1250 on the upside, with the stop loss at 1125 on the downside. The second stock is the sell in HAL, Hindustan Aeronautics. And now this is one space which has seen massive outperformance, and off late we're seeing some kind of a cool off and maybe a distribution pattern, I can say, on chart structure. So I believe there is more downside in HAL, so one can go ahead and short the futures as well at current levels for a target of 4,500 on the downside, with the stop loss at 5,000 on the upside.
Okay, all right, got that. Thanks very much, Aditya, for the trades for today. We'll take a break on that note, come back on the other side, and we'll get you more on the markets as well as a special conversation lined up. We'll have K. Ramakrishnan of Kantar to focus on demand trends in the FMCG sector. Stay tuned for that chat.
It's a volatile, wobbly market. The Nifty is all but in the red right now. But one spot of green in this market is FMCG. In fact, it's been holding up one end for the last 10-15 trading sessions, and that's largely on account of good outlook coming in from the rural part of consumption. The FMCG index at the high point, even as the Nifty is at the low point of today's trading session. What's doing well in the FMCG segment? We're talking about three themes here. One, the rural challenge. Are we coming out of the rural challenge? 65% of households and 52% of volumes come in from rural India. The second part is premiumization and urban premiumization in particular. Urban consumption has been holding up FMCG for the last couple of years. Has that hit a growth wall or not? And the third one, of course, we're looking at these big, specialized changes coming in, specialized ingredients, convenience channels like quick commerce, a lot of local brands, etc. doing well. So with all these three as a troika, let's get discussing with Ramki of Kantar World Panel Division in Asia. Joins in. He's been an expert tracking the space for a while. We're happy to have you in the studio.
My pleasure.
The first question obviously is rural. Every company so far has been talking about there have been green shoots of rural recovery, and they expect it to be a full-blown harvest towards the end of this year.
Yeah.
What have your data points on the ground level indicated?
Absolutely. So always rural has had a lag against urban. I mean, if you see COVID, urban saw COVID in 2020, rural was 2021. Inflation was earlier, rural was later. Similarly, the recovery of rural from inflation also has been later, and which is why we are beginning to see some green shoots in rural. And that has resulted in the last 2 quarters, the growth rate in rural overtaking the urban growth rate. That's one. Second is all the macroeconomic factors, which is typically what would you look at in rural? You look at monsoon, harvest, non-farm employment, and you look at support pricing. All of them are at the moment seemingly very positive. So given all of these and the fact that there is a line which is pointing that,wards, we tend to believe that rural is poised for a little more growth than where it is right now.
Some numbers, growth would be what?
So at the moment, it's rural is at 4.2% and urban is at 3.9%. We expect rural to go up to 6 by the end of this financial year. So that is the big hope for a lot of.
And how would that compare to, say, pre-COVID, the normal before COVID?
No, before COVID, if you go back to 18 and 19, rural has touched double digits, right? It was in 11, 12. One is not able to see at the moment immediately whether there is any time frame by which we can look at those kind of growth rates, but definitely 6 is looking feasible in the next 7 months.
6 is looking feasible, and you've also attributed, stability in macros, bringing seismic shifts in rural demand. So 4.2 turning into 6 on that base, not particularly bad. Let's talk about the other part then, urban, because urban has been leading growth for the last 2 years, if not more than that, and urban premium in particular. Now everyone's talking about consumption fatigue, middle class pockets being pinched, etc. What happens to urban consumption? I mean, premiumization as a theme, is it still on the cards, or is it hitting a bit of a roadblock?
Right. So we earlier spoke about rural and how that's the hope. Rural is always a penetration-led growth, right?
Yes.
Getting into more households with a new brand or a new category. Urban, yes, there is room for penetration growth, but more than that, it's going to be consumption growth or price growth. Those are the waves that one sees in urban. In urban, there are some positives to look at. I mean, it is flattish at around 3.8 to 3.9 kind of numbers. But the good parts in this are that the premium end is seeming solid. And so therefore, every brand, every company has a portfolio. And the numbers are going to come from the volume, the spends towards which on driving penetration is getting more and more. And that has to be compensated by something at the top, which is definitely kicking in quite well. And that's why the premium end we are talking about. Where are the premiumized categories working better? Categories which make the life of the consumer better, or which make convenience-oriented categories are doing well, and to some extent health-oriented categories towards this spend. Yeah.
Okay, and categories which make you feel better or look better or become prettier, right? So beauty and personal care, I'm sure. So just to sort of map this to the listed universe, and I think over the last 1.5 years, the problem is that these are great companies with great cash, but no growth or very low growth, right? 2-3% growth at rich valuations. Do you see that changing? I'm not asking you a buy-sell question, but the question is there another kicker somewhere around the corner for the listed FMCG universe?
Right. So the FMCG world is like, I mean, if you take a 20-year universe, I mean, we've all been seeing that it's always lagged the growth in GDP, right? GDP growth versus FMCG growth, always there's a lag. So therefore, what is happening in the FMCG world is that the money, there is a basket of money available with the consumer. But it's going towards a lot of things. It's going towards telecom, it's going towards healthcare, it's going towards... So that money is not getting... The consumer is not getting attracted enough by FMCG to spend that money.
Which is a point even for rural, and that's one part of the debate, that when there is more money in rural India, whether that money will be spent on buying maybe jewelry from the nearest Tanishq or maybe a premium car, rather than more spends on toothpaste or a better soap. So I think that's a real debate.
So when there's more money available, one end is the premium car. I'm saying there's the other is to build some mobility. Two-wheeler, tractor,
aspirational
or
rural India.
all of those. And even healthcare. I mean, the increased awareness of healthcare, and so therefore spending on healthcare, etc. That takes away money that comes into FMCG.
Absolutely.
So I think a task for FMCG companies is cut out in terms of how to make it more interesting and exciting for the consumer to part with that little bit of more money. That's where it is.
I would assume a lot of the money is also taken away by, cell phones and the internet data costs on a month, 400, 500 rupees taken out. That's taking away from the consumption of FMCG products or better consumption out there as well. Final question then before we let you go. What are the categories and companies of the future according to you? This is again not a buy-sell recommendation. And is the wave of D2C on the wane after funding winter coming in? We've seen a couple of successes out there, a couple of good listings too. But by and large, what are your thoughts on D2C and categories and companies of the future?
Yeah, so in terms of categories, I would say that the wave that we saw with Swachh Bharat for home care, which is for toilet bathroom cleaners and insecticides, that wave to some extent is continuing for sure. In personal care, definitely the premium end is something that one needs to watch out for. And in food, the convenience foods, biscuits are definitely categories to watch for. That growth is definitely continuing. Snacks are a little bit of stress. I mean, after a lovely 5-year ride, snacks are in a little bit of a slowdown at the moment. Companies, I won't be able to name them in terms of what.
All right, you spoke about biscuits doing well. Incidentally, Britannia reports its numbers tomorrow. The street expects them to have about 7 to 8% sort of volume growth. So, Ramki, thank you so much for joining in, giving us a lowdown on what the FMCG sector looks like. The headline from here is that rural may actually grow at 6% by the end of this year itself. We take a short break, come back, talk about markets and more stock-specific action on the other side.
Welcome back here with us on Halftime Report. Well, let's talk more about some primary market action. FirstCry's parent Brainbee Solutions will be launching its IPO on the 6th of August. FirstCry, a brand synonymous with new mothers and baby products in India, has a gross revenue of 25,000 crore rupees and more than 9 million unique transacting customers. Our colleague Reema Tendulkar caught up with Supam Maheshwari, CEO of FirstCry, to discuss their growth outlook, their plans, and she started off by asking him about when the company will turn profitable. Take a look.
This is a very large industry in the first place. We are addressing $34 billion. India creates 26 million babies a year. And we will be $68 billion of the size of the market by CY28. And with such a large market which is growing at a 20% CAGR, it is bound that we will have a journey of our own. If you look at our India multi-channel, it's actually already profitable. We have been profitable for last 4 years in the adjusted EBITDA basis. Our last year adjusted EBITDA was around close to 8.8% for FY24 for an India multi-channel business.
Let's talk about your gross margins. Your gross margins have ranged between 30 to 35%, which is lower than the direct retailers. Any of the listed retailers, they all have minimum gross margins of 40%. Why is yours lower? And you spoke about improving gross margins.
So we have been, obviously, all these years we have been improving gross margin. If you look at our gross margins for last 2 to 3 years, they've been improving year-on-year basis without having any year that we have not improved our gross margin. And this will be a factor that we will be able to improve our assortment mix, our curation, our investment in brands, our investment in our home brand strategies, which essentially will mean that we will be able to continue to compound our gross margins over a longer period of time. Our journey has just begun, although we may look like 13 years.
So 40% plus gross margins is possible, right?
Look, others have done it. We should be able to do it, but we will get there in our journey as we go along. I can't say for the future, but we will definitely strive to get there. It's not something impossible.
Okay. Let's break up your business into India, which is about 70% of your revenues. You have international presence in UAE and Kingdom of Saudi Arabia. And then you have a house of brands, D2C investments in 21 entities, which you house under Global Base. Now, India revenues in particular. Now, FY24 appear to be a bit of a slower growth for you. Reported revenues have gone up by just 7%. Your EBITDA margins are between 8.5% to 9%. Again, lower than the listed peers. What can you guide on the India business?
So look, we are not at a steady state. We are a new age, ecosystem modeled retail organization today. We believe that we will be able to, continue to grow in India as well as international and as well as in global Bs, because some of the other adjacencies that we have done are very recent, very young. From a profitability standpoint, obviously we have grown meaningfully in India from, as I said, from 5.9 to 6.2 in FY23 and 8.8 in FY25.
That's
if you
the
look
margin.
at our that's adjusted EBITDA margin.
EBITDA margins, yeah.
Because that's how you should look at the company, because that's the operating adjusted EBITDA margins, and this will continue, and we are not at a steady state. I can only say,
so what are
when you
steady
compare
state
with
margins
listed,
for the India business?
Other listed players are at a very tall EBITDA margins, okay, and we aim to get there. We are in our growth. We will be investing out of the use of proceeds that we will raise from the public markets. We will invest behind our brand, our technology, our supply chain, getting more customers, and with that we believe that we will be able to continue to expand our gross margins, our operating leverage, and through our marketing cost and so on and so forth, and essentially driving up the operating. Absolutely.
So what are tall EBITDA margins that you're comparing?
Look, they are in high teens. I mean, the good companies, we always sort of benchmark ourselves to leaders who have done there and have become, So
aspirationally, which is that company?
Well, there are good companies. There are all good companies where...
Name two.
I like in person, companies like Page Industries.
Okay.
Yeah, I mean, that's one company I believe they've done very well in terms of EBITDA margins. Even for that matter, Trend.
UAE and Saudi Arabia, because that is bleeding for you. That's the biggest drag for you at the bottom line. EBITDA losses in the international business was 140 crore in FY24, 120 crore in FY20. How long will it be loss-making? Is there a turnaround plan? What is your turnaround plan?
We started in UAE in October 19 and in Saudi Arabia, in Kingdom of Saudi Arabia in August 22. And we have not even finished 2 years.
Yeah.
This month we will finish.
So how long does it take to turn around?
So it will be a couple of years as the journey has been in India.
So India took how long for you to turn around?
Well,
if you
India
want to
took-
copy the same playbook.
Well, India would take a little longer because we started from scratch,
Okay.
right? And in international markets, it won't take that kind of long time because we took all our strengths at a platter, right? And then actually we have done all, the hard work of building our supply chain, our tech
So 5
platform,
years,
brand.
10 years from now?
No. I don't think that's too long.
It's
If
too
you-
long.
It's too
Not
long.
even 5 years. It should turn around before that.
Well, much earlier than that.
Next year?
No, I won't say that.
Welcome back. We're talking about big earnings today. Adani Ports, as we speak, at the bottom of your screen, 47% jump in the net profit. Of course, we had a quarterly volume update coming by, so we'll get in some more details. As of now, the stock mildly in the green. Another earning that we're looking at is ITC. Stock up 16% in the month of July. No tax hike in budget. Improvement in outlook and valuation aids move. Stock at around 28 times. What is it that the street is expecting? 2 to 3% growth in cigarette volumes, 7 to 8% growth in FMCG revenue, 8 to 9% increase in hotel revenue, and 0 to 2% growth in agri revenues, whereas there would be a decline in paper business on account of macro weakness. Put all of that together, overall you're looking at a revenue growth of about 5.5%, 16,700 crores on the top line, 6,400 crores on the EBITDA, and the net profit at around 5,100 crores. We'll keep an eye out on all of this as we look at numbers at the bottom of your screen and look at numbers that will be reported as well. That's about ITC, and that's all the time that we have on this edition of Halftime Report. Thank you for watching.